So Munis, we talked about we had talked about curve shape a little bit earlier, but there has been so much that has gone inside of Munis for quite some time. It's not surprising that we're continuing to get not an exact map of the taxable story that we see in Munis. So let's start to get into that because I think that's very interesting.
Yeah, so I mean, I think when you think about the quarter, the first 2 months of the quarter were kind of playing out exactly like we thought they were going to. Yields were coming down, munis were outperforming treasuries, munis got really cheap last year because of all the supply, record supply year last year. So everything was kind of playing along. So you look on the right-hand side of the chart, the first 2 months, really strong performance. And then it was a perfect storm where everything got wiped out in March. What happened in March? First we had a lot of supply. Second, demand was kind of waning a little bit, but obviously the war caused treasury rates to spike. Munis underperformed treasuries for the month. So the good news about that is on the left-hand side of the chart, you can see the after-tax spread of munis went from almost nothing, right? You're getting less than 10 basis points to own a 10-year muni versus a 10-year treasury after tax to a really attractive level, almost 60 basis points. So basically flat for the quarter, but munis are a lot cheaper than where we entered.
And I promised a discussion about shape of the curve. So let's talk about the belly.
Yes. So the belly has been the best performing part of the muni market off and on for a couple of years now. And that's because there's been so much demand for SMA, intermediate SMA. Also, passive ETFs have gotten a lot of flows, and they just, no matter what the yield, no matter how expensive it is, they just plow into the belly of the curve. So the belly has been a strong performer. It was a big story last year. That is starting to reverse itself. And I think it's reversing itself for two reasons. One is just you're not getting, when investors are looking, how do I maximize yield? The belly is not how you do it. You get a lot more yield to barbell, so you're getting some investors starting to reject the belly. But also issuers. Issuers are looking at, okay, I can issue a 5-year bond at 2.25%, 2.5% yield, or I can issue a 20-year bond at 4.25% yield. They can cut their debt service dramatically by issuing the belly. And that's one thing that is changing pretty fast. You can see that on the upper right-hand side of the chart. The amount of bonds being issued in the belly of the curve has also changed. So you have less investor demand, and you also have more supply, and that's causing the long end to outperform, which is something that we think is going to continue.
I know this sounds wonky, everyone, that we're talking about the shape of the curve and where on the curve and funding costs and everything else. The devil's in the details here. There are legitimate opportunities inside of the curves themselves, buying and selling up activity, issuance that's inside of the marketplace. It really does offer value to be aware of all these developments because you can invest accordingly. And so yield curve positioning, as the title suggests, is key here.
Yes. And not to beat a dead horse here, but the long end of the municipal market is very, very cheap. You can see on the left-hand side, the yield curve is substantially steeper than the treasury curve. And the reason that's important, whether or not you think the treasury curve is going to flatten or steepen, it almost doesn't matter. If munis go back to normal long-term relationships versus treasuries, the long end of the muni is going to outperform. And you don't have to get the timing exactly right because roll is back. The yield curve is steep. So you get bond roll by just holding a bond for a year. The price appreciation just of the passage of time is very, very attractive. Here you're looking at a 20-year bond, just a AAA 20-year bond. The yield plus the roll is close to 5% return. So barbelling maturity structure gives you more yield. It gives you more roll. You own the cheaper part of the curve, and you're getting paid to wait. We just think it's very important that you don't just buy a passive portfolio right now. You actively maneuver a portfolio to try to take advantage of the opportunities.
And for those of you who don't live and breathe this, a roll, when we talk about roll math, it's the increase in the price of a bond as it ages. So let's say you buy a 10-year bond and it yields, let's say 4%. And let's say a 9-year yields 3.8. If a year from now the yield curve hasn't changed, your 10-year bond it's a 9-year bond now, but it has a 4% coupon. It has to go up in price. So the yield comes down to the 3.8, right? So as you go down an upward sloping curve, the price continues to increase for a certain period of time. The steeper the curve, the greater those potential increases. And if the curve isn't, exactly shaped in a linear fashion, then parts of the curve, like the belly or whatever, start to become really attractive, and they can generate pretty meaningful performance. And then you alluded to the next slide, which is history is sort of a guide of what happens when you get a steepened out curve, which is eventually the flattening that sort of follows it.
Yeah, exactly. If you went back in history, so we saw a little bit of flattening in the first quarter, but we're nowhere near long-term averages. You can see the long-term average is less than 60 basis points. We're still over 100 basis points. And so you're still getting a lot of additional yield, a lot of additional roll. History, if history is our guide, so there's a lot of fundamental reasons for the muni curve to flatten. But even you just look at history, we're significantly higher than we are on average. And whenever that's happened historically, the long end has outperformed intermediates. So there's a lot of things building up for the long end of the muni curve to outperform.
And one of my favorite things, honestly, to talk about muni credit.
Yes. So the reason you like talking about it, the reason I like talking about it is there's almost no better after-tax, better risk-adjusted return in financial markets. So muni credit, the default rates historically almost round to zero. You get really nice tax equivalent yield. You can see that on the right-hand side. The tax equivalent yield of muni high yield is almost double digits. The tax equivalent of triple B munis is almost 8%. So really nice tax equivalent yield for something that doesn't default. But then the question is, how are credit fundamentals right now? And credit fundamentals still are really strong in the municipal bond market. Revenues still come in positive. Most revenues are coming in higher than budgeted in most states. Rainy day funds are still pretty close to all-time highs. You can see that in the middle chart. States have not been spending down their rainy day funds in most states. So you have really nice credit quality, low defaults, high tax equivalent yields, and also really good risk-adjusted returns. We do think it's a really nice time, if you do your homework, to know which bonds to buy to own muni credit.
All right, so let's put it all together.
Yep. So how do you want to build a portfolio today? You can see on the right-hand side, the AB Muni Credit Blend has a much higher yield than almost any other alternative. And the way that we achieve that is, one, by barbelling the maturity structure, where you get more yield and roll, but also adding in some mid-grade and high-yield credit in the portfolio. So if you barbell your high-grade portfolio and then you add in some mid-grades and high yield, you get well north of a 4% tax yield, which tax equivalent, you're getting close to 7%. That's for something that's single A average credit quality. That's a really attractive place to be in a very uncertain market.